For years, Americans have been told that real estate problems come and go in cycles. Prices rise, prices fall, interest rates move, demand adjusts. Everything eventually normalizes. That assumption is becoming dangerously outdated. The real estate issue facing the United States today is not a simple boom and bust cycle. It is something deeper, more structural, and far harder to reverse. And that is what makes it so serious. But at first glance, the problem seems obvious. Homes are expensive, mortgage rates are high, and affordability is stretched. But those are symptoms, not the disease. The real crisis is misalignment between supply and demand, wages and prices, debt and income, policy intentions, and market reality. For decades, the U.S. housing system relied on three stabilizers: expanding supply, predictable financing, and upward mobility. All three are now under stress at the same time. Housing supply has been constrained for years. Zoning restrictions, permitting delays, labor shortages, and rising material costs have made it difficult to build at scale. Even when demand surged, construction failed to keep up. The result is a structural shortage, not a temporary imbalance. At the same time, financing conditions shifted abruptly. After years of ultra-low interest rates, borrowing costs reset upward in a matter of months. This didn't just cool demand, it froze movement. Millions of homeowners are now locked into mortgages far below current rates, unwilling or unable to sell. This lock-in effect has created a paradox. Inventory remains tight, even as affordability worsens. Prices don't fall meaningfully, yet buyers disappear. Transactions slow, liquidity dries up. This is not a healthy market. It is a stuck one. Wages have not bridged the gap. While incomes have risen nominally, they have not kept pace with housing costs in most metropolitan areas. The traditional path, renting, saving, buying, has become increasingly unrealistic for younger households. That matters because housing markets depend on churn. First-time buyers allow move-up buyers to transact. When the bottom of the ladder breaks, the entire structure becomes unstable. Commercial real estate adds another layer of complexity. Office space, once assumed to be a stable asset class, faces a fundamental demand reset. Remote and hybrid work are not temporary trends. They represent a permanent reduction in utilization. Buildings designed for full occupancy now operate at fractions of that capacity. Yet, the debt backing those buildings was structured for a different world, one with predictable cash flows and steady refinancing options. As leases expire and values fall, refinancing becomes difficult or impossible without injecting new capital. Banks, lenders, and investors are all exposed not necessarily to catastrophic collapse, but to slow-burn deterioration. What makes this moment especially dangerous is that the risks are spread unevenly and reveal themselves gradually. There is no single shock that forces immediate recognition. Instead, values adjust quietly. Loan terms tighten. Credit availability shrinks. This is how real estate stress becomes systemic without ever making headlines. Policymakers face a dilemma. Intervene too aggressively, and inflation reignites. Do nothing, and affordability continues to erode while asset values stagnate. Meanwhile, households are caught in between. Homeowners feel wealthier on paper but less mobile in reality. Renters face rising costs with no clear path to ownership. Investors struggle to price risk accurately in an environment where historical assumptions no longer apply. This is why the real estate problem in America is not about panic. It's about fragility. The system still functions, but with far less margin for error. In the next section, we'll look at where this fragility is most visible: residential markets, commercial properties, and the growing disconnect between real estate values and economic fundamentals. One of the most misunderstood dynamics in today's real estate market is the lock-in effect. Millions of homeowners refinanced or purchased homes when mortgage rates were at historic lows. Those loans are now assets, not liabilities. Selling a home often means giving up a 3% mortgage and replacing it with a 7% one. As a result, people stay put. This reduces supply, keeps prices elevated, and prevents normal price discovery. Even households that would otherwise downsize, relocate, or adjust remain frozen by financing math. This lock-in doesn't just affect buyers. It reshapes labor markets, family formation, and regional mobility. Workers hesitate to move for better opportunities. Retirees delay downsizing. Younger families crowd into rental markets. Rental pressure rises as ownership becomes inaccessible. Landlords pass through higher costs. Affordability worsens at both ends of the spectrum. Commercial real estate faces a parallel but distinct problem. Office buildings were financed on assumptions of steady occupancy and long leases. Those assumptions are no longer reliable. Many companies have reduced footprints permanently. Others are renegotiating leases at lower rates. This compresses cash flows. Just as refinancing windows approach, debt maturities don't care about narratives. Loans must be rolled, paid down, or restructured. When valuations fall, refinancing requires additional equity, often unavailable or unattractive. This creates silent stress across balance sheets. Banks are not collapsing, but they are cautious. Lending standards tighten. Credit availability shrinks. Projects stall. Development slows further, worsening supply shortages in residential markets. It becomes a feedback loop. Real estate values are also increasingly disconnected from local income. Fundamentals. In many regions, prices reflect past financing conditions rather than present affordability. This makes the market brittle. Small shocks, job losses, regional downturns. Regulatory changes can have outsized effects because buffers are thin. Another overlooked factor is insurance. Rising climate risk has pushed insurance premiums sharply higher in many regions. In some cases, coverage is becoming unavailable at any price. Without insurance, financing becomes difficult or impossible. This affects coastal markets, wildfire-prone areas, and regions exposed to extreme weather. Property values in these zones face pressure that has little to do with demand and everything to do with risk transfer. Meanwhile, public infrastructure struggles to keep up. Roads, utilities, and services built for earlier population patterns strain under new ones. Local governments face rising costs just as property tax resistance grows. This puts municipalities in a difficult position. Raise taxes, cut services, or defer maintenance. None of those options support long-term real estate stability. The result is a market that appears resilient on the surface but is increasingly segmented beneath it. Some areas remain strong, others stagnate quietly. Liquidity becomes uneven. Risk becomes localized but interconnected. This is not the environment of a classic housing crash. It is something slower, more complex, and harder to hedge. In the final section, we'll look at what this means going forward. Who is most exposed, who is positioned to adapt, and how the real estate system is likely to evolve rather than reset. The most important thing to understand about America's real estate problem is this: it is unlikely to be solved quickly or cleanly. There is no single policy lever that resets affordability, restores mobility, and repairs balance sheets simultaneously. Any solution involves trade-offs. Lower interest rates might revive transactions, but they risk reigniting inflation. Higher rates stabilize prices but deepen lock-in and suppress construction. Subsidies help some buyers but inflate prices further if supply doesn't expand. Supply expansion itself takes years. Zoning reform, permitting changes, labor availability, and infrastructure investment do not happen overnight. This means the system adjusts slowly through reduced mobility, altered expectations, and generational shifts in ownership patterns. For households, this changes the meaning of homeownership. It becomes less about upward mobility and more about stability. Fewer moves, longer holding periods, less reliance on appreciation. For investors, it demands realism. Cash flow matters more than projected appreciation. Location risk must be evaluated alongside climate, insurance, and regulatory exposure. For lenders, underwriting assumptions must reflect volatility rather than historical averages. Conservative structures become essential. The commercial side will continue to reprice, not collapse, but adapt. Some assets will be repurposed, others will be written down. The adjustment will be uneven and prolonged. What emerges is a more fragmented real estate landscape. Some regions thrive due to affordability, infrastructure, and population inflows. Others stagnate or decline quietly. The national averages hide these differences, making risk harder to spot without local insight. This environment rewards patience, flexibility, and realism. The biggest mistake is assuming the past decade is a reliable guide to the next one. Real estate still matters. Housing still matters. But the rules have changed. America does not face a housing crisis in the dramatic sense. It faces a structural real estate problem, one that reshapes behavior, expectations, and financial planning over time. Recognizing that early is not pessimism. It is preparation.